So, if you're a high earner or a business owner, you know exactly how hard you work for your money. But here's the real question. Are you working just as hard to keep it? Today, we are diving deep into some really powerful tax strategies that can help you protect and preserve your wealth.
Let's just kick things off with a number that might honestly shock you. For a lot of high earners, their total tax rate can hit 50%. Think about that for a second. That means you could be spending half the year, 6 entire months, working just to pay your tax bill. Everything you earn from January straight through to June could be going right to the government.
And to really put that 50% figure into perspective, let's zoom out and look at it over a decade. If you spend half of every single year working for the tax man, that adds up to five full years of your career, your effort, your hard work, just handed over. It's an incredible amount of your life's work. So that's the big question, right? How do you actually break out of that cycle? How do you stop watching such a huge chunk of your money walk out the door every year? Well, the answer isn't about making less, it's about being way smarter with the money you make. And that's exactly what we're going to break down right now.
Okay, first up, let's open up what I like to call the income saving toolkit. These are strategies you can put to work immediately to lower your taxable income, which lets you keep more of what you earn and, just as importantly, grow it way more efficiently.
Inside this toolkit, we're going to hit on 3 super powerful tools. We'll start with the basics like retirement accounts, then move to the seriously underrated HSA, and finally, tax-free bonds. You know, the foundation of any smart tax plan pretty much starts right here. When you put money into a traditional 401k or an IRA, you're using pre-tax dollars. What does that mean? It means you immediately lower your taxable income for this year. But the real magic, the part that gets exciting, is what happens next. Your investments get to grow tax-deferred, compounding year after year without that annual tax drag slowing them down, all the way until you retire.
Now, let's talk about one of the most powerful and, honestly, most overlooked savings tools out there. It's the Health Savings Account, or HSA. If you happen to have a high-deductible health plan, this is an absolute, no questions asked, must-have in your financial life.
This is why you see financial pros get so geeked out about the HSA. It's a triple tax threat, and I mean that in the best way possible. First, your contributions are tax deductible, so they lower your income right now. Second, you can invest that money and it grows completely 100% tax-free. And third, when you take it out for qualified medical costs, those withdrawals are also tax-free. No other account in the US tax code can do all 3 of those things. It's incredible.
So, are you looking for a way to generate some income without having to give a big slice of it to the IRS? Well, for anybody in a higher tax bracket, municipal bonds can feel like you've struck gold.
Here's the deal with these. The interest you earn from muni bonds is completely exempt from federal income tax. Gone. But it gets even better. If you buy bonds that were issued by your own state, that income is usually free from state and local taxes too. It's one of the cleanest, most straightforward ways to build a totally tax-free income stream.
All right, let's shift gears a little. We've talked about saving on your current income. Now let's talk about building for the future. This is what we'll call your legacy building toolkit. It's all about direct tax savings and protecting your wealth for the long haul.
In this section, we're going to explore the amazing dollar-for-dollar power of tax credits. And then we'll get into the essentials of estate planning so you can pass your wealth on as efficiently as possible.
Okay, listen up, because this is a point that trips up so many people. But getting this is an absolute game changer for smart tax planning. Deductions and credits both save you money, that's true. But they work in fundamentally different ways, and one is way more powerful than the other.
So here's the key difference, right? A deduction, like that 401k contribution we talked about, reduces the amount of your income that the government gets to tax. That's good. But a credit? Oh, a credit is way better. It's a dollar-for-dollar reduction of your final tax bill. So a $1,000 credit literally saves you $1,000 in cash. It directly slashes what you owe. So where do you find these little pots of gold? Well, they often come from things the government wants to encourage people to do. Think about making solar energy upgrades to your home, or paying for college, or covering childcare costs. Each of these can lead to some seriously powerful direct savings right on your tax bill. And finally, let's talk about the long game. And listen, estate planning is not just for the mega wealthy. It's for anyone who's worked hard to build something and wants to make sure those assets actually get passed on to their family, with the absolute minimum amount getting lost to taxes along the way. And there are a ton of sophisticated tools that can help with this.
You've got things like irrevocable trusts, which can move assets out of your taxable estate to shield them. You can use strategies like annual gifting to pass on wealth tax-free while you're still here. And understanding a rule called step up in basis is absolutely crucial, because it can save your heirs from a massive capital gains tax bill down the road.
So, after all that, what does this really add up to? Look, the whole point of these strategies isn't just about saving a few bucks here and there. It's about taking active, conscious control of your financial future and making damn sure your money is working for you, not just for the IRS.
So here it is, the complete toolkit, all in one place. You're using retirement and health accounts to shrink your taxable income, using municipal bonds to grow money tax-free, and then you're using powerful credits and smart estate planning to directly cut your tax bill and protect your legacy.
The final message here is simple, but it's really powerful. You earn this money. And by being proactive, by using the strategies that are available to you, you can make sure you stop letting the IRS take more than its fair share. And that really brings us to our final question. And this is one I want you to really think about. Take a hard look at your own finances. Is your wealth plan genuinely designed to benefit you and your family? Or have you, maybe without even realizing it, just been working for the taxman this whole time? Answering that question is the first step to making a real change.